In the year 1262, Venice had a problem. It had lost Constantinople and needed money to rebuild its fleet. The solution was ingenious and ruthless. The government forced its wealthiest citizens to lend it money. It wasn't voluntary. It was a forced loan. But in return, Venice promised to pay 5% annual interest every 6 months, with no maturity date. These loans were called prestiti. And here's the important part: they were transferable. If you had lent money to the Republic and needed to get it back, you could sell your right to collect the interest to someone else. And that person could sell it to a third party. The government bond had been born. A piece of paper representing a promise: I lend you money now, and you pay me back with interest later. 800 years later, the global bond market moves more than $100 trillion. More than the stock market. More than the commodities market. It's the biggest market on the planet, and most people don't know it exists. In the previous episode, we discovered the stock market and how shares allow you to own part of a company. But shares are only one part of the financial world. Today we're going to explore 3 more markets: bonds, where governments and companies borrow money; commodities, where oil, wheat, and gold are bought and sold; and derivatives, those instruments that can be tools of protection or weapons of financial destruction. They're less famous markets than the stock exchange, but equally important. And understanding how they work is essential for grasping the modern financial system. A bond is, in essence, an IOU. When you buy a Spanish government bond, you're lending money to the government of Spain. In return, the government promises you 2 things: to pay you periodic interest, called a coupon, and to return your principal at the end of a set term, called the maturity. If you buy a 10-year bond with a 3% coupon and a face value of €1,000, you'll receive €30 a year for 10 years, and at the end they'll return your €1,000. Sounds simple. And it is, until you realize that bonds are bought and sold on a secondary market, just like stocks. And there things get complicated. If interest rates rise after you buy your bond, new bonds appear that pay more. Your bond, which pays 3%, is no longer as attractive. If you want to sell it, you'll have to lower the price. The bond price falls. If interest rates drop, the opposite happens. Your bond, which pays 3%, is now more attractive than new bonds. Its price rises. This inverse relationship between interest rates and bond prices is one of the most important laws of finance. And it explains why central bank decisions about interest rates reverberate throughout the entire financial system. There's a key concept you need to understand: yield. A bond's yield is not the same as its coupon. The coupon is fixed. But if the bond's price changes on the secondary market, the effective yield also changes. If you buy a €1,000 bond with a 3% coupon for €900, your actual yield is higher than 3%, because you paid less but received the same coupon. Investors look at bond yields from different countries to assess risk. The German government bond is considered virtually risk-free. If the Spanish bond pays a higher yield, the difference is called the risk premium, and it reflects the market's perception of the likelihood that Spain might not be able to pay. When Spain's risk premium spiked during the euro crisis in 2012, it wasn't an abstract number. It meant investors doubted Spain's ability to repay its debt. And that doubt had real consequences. The government had to pay more interest, leaving less money for public services. Bonds from the most stable countries, Germany, the United States, Japan, pay low yields. Bonds from the most unstable countries pay high yields to compensate for the risk. That's the risk premium in action. Bond history includes a curiosity worth noting. In 1751, the British government consolidated several debts into a single instrument called a consol, short for consolidated annuity. It was a perpetual bond. It had no maturity date. The government paid a 3.5% annual coupon forever, or until it decided to buy the bond back. Consols financed the Napoleonic Wars, the expansion of the British Empire, and a good part of 19th century infrastructure. They became the benchmark of the global financial market for more than a century. The last consol was redeemed by the British government in 2015, more than 260 years after its creation. It's possible that a bond issued in 1751 had passed through hundreds of hands before finally being cancelled. We leave bonds and enter a completely different market. The commodities market. Here you buy and sell what comes from the earth and the sea. Oil, natural gas, gold, silver, copper, wheat, corn, coffee, cotton, sugar. The physical ingredients of the economy. These markets are as old as trade itself. But they were radically transformed when someone invented a tool that allowed trading commodities without physically having them on hand. It's called a futures contract. In 1697, in the city of Osaka, Japanese rice merchants created something unprecedented. At the Dojima Rice Exchange, they didn't just buy and sell physical rice. They traded contracts to deliver rice at a future date at a price agreed upon today. If you were a farmer and feared the price of rice would fall before harvest, you could sell a futures contract now. You locked in a fixed price. If the price fell, you were protected. If it rose, you'd given up the extra gain, but in exchange you had certainty. If you were a merchant and feared the price would rise, you could buy a futures contract. You locked in a fixed purchase price. The futures contract was born as a risk management tool. Farmers and merchants used it to protect themselves from uncertainty. Economists call this hedging. In 1848, grain traders in Chicago founded the Chicago Board of Trade, which standardized futures contracts, fixed volume, fixed date, fixed quality. That standardization made it possible for contracts to be bought and sold like any other financial asset. Futures contracts are a type of derivative. They're called that because their value derives from the price of another asset. An oil future derives its value from the oil price. An Apple stock option derives its value from Apple's share price. There are two main types of derivatives besides futures. Options give the right, but not the obligation, to buy or sell something at a set price within a set period. If you own shares and worry they'll fall, you can buy a put option that protects you. It's like insurance. Swaps are exchanges of payment streams. The most common is the interest rate swap. A company paying a variable rate exchanges its payments with another paying a fixed rate. Both reduce their risk. When used to manage risk, derivatives are powerful and legitimate tools. They allow farmers to plant without fearing a price collapse. Airlines to buy fuel without fearing a price spike. Companies to plan long-term in a world of uncertainty. But derivatives can also be used to gamble. If you buy an oil future without having oil or any intention of buying it, you're speculating on the price. And when speculation gets out of control, derivatives can amplify crises to catastrophic levels. Warren Buffett called them financial weapons of mass destruction in 2003. Not because derivatives are inherently bad, but because in the wrong hands and without proper regulation, they can destabilize the entire financial system. We'll see exactly how that happened when we reach the 2008 crisis in Season 9. But the principle is the same since Dojima, a tool designed to reduce risk can, if used irresponsibly, multiply it. There's a market bigger than stocks, bigger than bonds, bigger than commodities. It's the foreign exchange market, or Forex. Every day, more than $7 trillion in currencies are traded. $7 trillion. Every day. It's the world's largest and most liquid market, and it has no physical headquarters. It operates 24 hours a day, 5 days a week, through a global network of banks, funds, and traders. Why is it so huge? Because every international transaction involves a currency exchange. When a Spanish company buys components in Japan, it needs yen. When a Japanese tourist visits Spain, they need euros. When an American fund invests in European stocks, it needs euros. The exchange rate between two currencies is determined, like everything else, by supply and demand. If there's strong demand for euros, the euro appreciates. If there's a lot of supply and little demand, the euro depreciates. But the currency market is also profoundly influenced by central banks, interest rates, inflation, and politics. When the European Central Bank raises interest rates, investing in euros becomes more attractive, euro demand rises, and its value appreciates. Forex is where macroeconomics meets the market. And its movements affect the price of everything you import and export. These markets might seem distant and abstract. Bonds, futures, derivatives, currencies. Sounds like banker speak. But they affect you directly. When government bond yields rise, the government pays more interest. That money comes from taxes. It comes from education budgets, from healthcare, from infrastructure. The risk premium isn't a number on a screen. It's the difference between building a hospital and not building one. When wheat futures rise due to speculation, bread gets more expensive. In Europe, that means spending a few extra cents. In a developing country where families spend half their income on food, it means hunger. And when derivatives are used irresponsibly, the financial crises they cause destroy jobs, savings, and lives. The 2008 crisis started with derivatives on mortgages that almost nobody understood. It ended with millions of people losing their homes. These markets are extraordinarily useful when they work well, and extraordinarily dangerous when they don't. And the difference between those two scenarios usually comes down to one word: regulation. 3 ideas to take away from this episode. First, a bond is a loan you can buy and sell. Governments and companies issue bonds to finance themselves. Bond prices move inversely to interest rates. The risk premium reflects the market's confidence in the issuer. Second, commodity markets and futures contracts were born to manage risk. Derivatives, futures, options, swaps are hedging tools that can also be used for speculation. Their misuse can amplify financial crises. Third, the foreign exchange market is the world's largest. The exchange rate affects the price of everything that crosses a border and is influenced by monetary policy, interest rates, and market expectations. Markets create wealth, spread risk, and coordinate billions of decisions. But sometimes they go mad. When prices disconnect from reality and everyone believes they can only go up, a bubble inflates. And sooner or later, it bursts. In the next episode, we'll travel to 17th century Holland, 18th century England, and turn of the millennium America. Tulips, South Seas, and dot-coms. The greatest financial manias in history. That's next time.